We're looking at module 8 on international finance, which will be dealing on multinational banking and financial institutions. By way of module objectives, at the end of this module, students should be able to understand the role and functions of multinational banks and how they operate within the global financial system. You should be able to analyze the impact of international financial institutions like the IMF and the World Bank on global economic stability and development. We also they should also be able to examine cross-border financing techniques and the regulatory frameworks that guide international banking activities. They should also be able to evaluate the causes and consequences of global banking crisis and their effects on multinational banks and the global economy. They should also be able to explore the importance of global banking regulations and their roles in ensuring financial stability, preventing crises, and protecting consumers. By way of introduction, multinational banking and financial institutions are critical pillars in the global economy, playing a central role in facilitating international trade, investment, and economic development. These institutions operate across borders, enabling the flow of capital, facilitating cross-border payments, managing foreign exchange risk, and supporting global economic stability. The rapid globalization of trade, capital, and finance has led to the increasing importance of multinational banks and financial institutions, which now operate in multiple countries and regions, helping to meet the financing needs of governments, corporations, and individuals. This module explores the roles and functions of multinational banks, the significance of international financial institutions like the International Monetary Fund and the World Bank, and the regulatory environment governing cross-border financing. Additionally, we will examine global banking crisis and their widespread impact on the financial system and economies. What are some of the functions of multinational banks? We have one, capital mobilization. Multinational banks act as intermediaries between investors and borrowers, raising capital through deposits, issuing bonds, offering loans to businesses and governments. An example, they help to fund infrastructural projects in developing countries and provide working capital to expand multinational corporations. They also carry out foreign exchange and currency management. Multinational banks facilitate currency exchange and offer hedging products to mitigate the risk of currency fluctuations in international markets. An example is they provide foreign exchange services to businesses involved in international transactions, helping them mitigate risk posed by changing exchange rates. And we also have debt financing. NMBs provide trade finance instruments such as letters of credit and trade credits to ensure that international transactions are secure and payments are guaranteed. Risk management. Multinational banks help businesses manage risk related to currency fluctuations, exchange rate changes, and commodity price volatility through hedging products like derivatives. This is a diagrammatic representation of a multinational bank. This is them in a board meeting. Let's look at foreign exchange and currency management. Currency risk, this is one of the challenges faced by multinational corporations. Is the risk of managing is the problem of managing the risk associated with fluctuating currency exchange rates. Then we also have hedging products. Multinational banks offer products like forward contracts, options, and swaps to mitigate currency risk. These products allow businesses to lock in future exchange rates and protect themselves from adverse fluctuations. An example is a US company importing from Europe can use a forward contract to lock in an exchange rate, preventing losses if the euro strengthens against the dollar. NLBs also provide advisory services on currency risk management, helping business design strategies to reduce their exposure to currency fluctuations. We have trade financing in multinational banks. Under this, we have letter of credit. Letter of credit is a guarantee from a bank that a seller will be paid if they meet the terms of agreement. It is commonly used in international trade to reduce payment risk. Then trade credit. This is a short-term financing provided by banks to facilitate the smooth flow of goods across borders. It introduces the financial strain on businesses engaging in international transactions. Then we have supply chain financing. But national banks offer solutions that provide liquidity to suppliers, ensuring that goods are delivered on time and payments are made efficiently. An example is the US business importing from China uses a letter of credit to guarantee payment to a supplier, ensuring a smooth transaction. Let's look at the role of IMF and World Bank in multinational banks. IMF provides short-term financial assistance and policy advice to stabilize economies facing balance of payments problems. The IMF provides or ensures global monetary stability to coordinating fiscal policies among member countries, while the World Bank focuses on long-term development assistance, providing funding for infrastructure, education, and poverty reduction projects. An example is the IMF provided financial assistance to countries like Greece during the Eurozone debt crisis, while the World Bank funded projects for the rural development in Africa. Let's look at some of the global banking crises and their impacts. 2008 financial crisis, that is the collapse of the Lehman Brothers and the housing market crash, triggered the global banking crisis, leading to a widespread financial instability. The causes were excessive risk-taking, speculative investments, and systemic failures within major financial institutions contributed to this crisis. The impact is that it affected global liquidity, causing a recession and led to stricter financial regulations aimed at preventing future crises. Let's look at cross-border financing techniques. We have FDIs, we have syndicated loans, we have Eurobonds, and all. Let's look at FDI. We have talked about FDIs in past modules. This is a long-term investment in foreign market through joint ventures, securities, or acquisitions. What about syndicated loan? This is a group of banks or financial institutions pooling resources to provide a large sum to a borrower for cross-border investments. Eurobonds, these are bonds issued in foreign currencies, allowing companies or governments to raise capital for international investors. An example is an international corporation that uses a syndicate loan to finance the construction of a new plant in an emerging market. Let's look at some of the banking regulations and global financial stability. We have base 3. This is a banking regulation. This is a set of banking regulations designed to improve the bank capital adequacies, stress testing, and liquidity management. Then we have the anti-money laundering, AML, and know your customer, KYC. These are banking regulations. These are regulations that ensure that banks prevent money laundering and adhere to strict consumer verification procedures. The purpose is that these regulations are crucial for ensuring global financial stability and preventing illegal financial activities. By way of conclusion, global banking crisis represents a major threat to financial stability and economic growth. These crises often arise from excessive risk-taking, speculative market behaviors, and systemic failures, leading to widespread disruption in the banking sector and the global economy. The impact of such crises include economic contraction, increased regulation, and a loss of investor confidence, all of which take years to recover from. The global financial crisis serves as a stark reminder of the vulnerability of the global financial system and the interconnectedness of financial institutions. Multinational banks and financial institutions must adopt these rigorous risk management practices, focus on financial stability, and comply with international regulations to prevent the occurrence of future crises. Additionally, the role of international organizations like the IMF and the World Bank becomes crucial in managing the aftermath of banking crisis by providing financial support, policy advice, and technical assistance to countries in need. As the global financial landscape continues to evolve, multinational banks must adapt to changing market conditions and regulatory environments. Effective risk management and robust financial regulations are key to ensuring the stability of banking systems and minimizing the adverse effects of future crises. At the end of this module, there's an assessment where part A involves 15 minutes quiz and part B will involve the report. That will be all for module 8. I'll see you in module 9.